The next important aspect that we come to is prudential regulations. So, prudential regulations, as the name suggests, the RBI wants the banks, financial companies, including HFCs, to be prudent and mindful of what they are lending and whom they are lending to. The reason is very clear. What you can do as an exercise is that pick up any balance sheet of any bank or a finance company, whichever you like, and go through the balance sheet. In the balance sheet, you will have two parts to the balance sheet, the liability side and the asset side. As far as the assets are concerned, majority of the assets will obviously consist of loans and advances given. There will be a part for investments also, and a small part which will consist of fixed assets. So for now, we leave the fixed assets and the investments aside, and we'll only concentrate on the loans which are given. On the liabilities side, you have two parts. Again, you have the equity shareholders funds and you have the outside liabilities. Now, these outside liabilities consist of loans that the finance company has taken from other banks or other financial institutions, NCDs, which is non-convertible debentures, commercial paper, which is typically a short-term debt, fixed deposits, which common people place with the finance company or a bank. You will also have external commercial borrowings, that is those borrowings which the finance company or the bank has borrowed from outside of India. And there may be other instruments also, but all in all, these consist of outside liabilities. Now, when I say outside liabilities, these are liabilities which are due to people who are not shareholders. Now, the difference is that in a bank or in a finance company, if you see the balance sheet, the liabilities side there will be a mismatch between the equity shareholders funds and the outside liabilities. When I say mismatch, I am not trying to say there is something illegal. But the thing is that the proportion of the capital which is contributed by the equity shareholders will be far less than the outside liabilities. Typically, this ratio is anywhere between 20% equity and 80% to about 15% equity and 85% outside debt. Now, why does this have an impact? The reason is very simple, that as far as the outside liabilities are concerned, a majority of them are fixed rate. When I say fixed rate, for example, when you place a deposit with a bank, you are given a fixed rate of interest for that particular time frame, say 7% or 8% or whatever it is. The bank is supposed to pay you 7% interest for a deposit of 3 years, and this rate has to be paid irrespective of the fact that the bank makes a profit or it makes a loss. Whereas as far as the equity shareholders are concerned, the return given to them may not be fixed, or it is not fixed. So it is very simple that the bank or the finance company is picking up funds from equity shareholders and the debt holders and making the same use. When I say the same use, it is using that money to give loans to outsiders or for the purpose for which it is formed. In our case, for housing loans. Now, assume that you are giving a loan and the bank is able to earn 14% interest. Now, what will happen is that the debt holders or the outside liabilities will be paid fixed 7% return only, whereas the balance profit that the company has made will all flow to the equity shareholders. Let us assume that the bank is able to make 20% return on the balance sheet. Then, even in this scenario, the debt holders are left with 7% and the equity shareholders gain 13%. Now, what does this lead to? This leads to a simple question, that in the loan from which the bank or the housing finance company is making this exorbitant profit, a small portion is contributed by the equity shareholders and a major portion is contributed by the debt holders. Now, you see any recent scandals, be it the PMC failure or the DHFL or any other failure for that matter, who were the people who actually lost money? You can say equity shareholders did lose money, but then out of the total balance sheet size, their loss was restricted to 20%. 80% of the loss was by the debt holders. So they actually took a higher risk. Even though in theory it is the equity shareholders who take risk, in the practical world it is the people who placed fixed deposits who had to bear the loss. The other thing is that the equity shareholders, when they invested the money into the shares, they did it knowingly, and they were already aware of the risk that they run, and they had taken that risk consciously. Whereas the deposit holders were somewhat under the assumption that the fixed deposits or the NCDs that they are investing in are secured and that they will get their money back. And it is somewhere unfair to the debt holders who are contributing a far higher amount to a particular loan and getting a fixed return, even where the bank is able to make a higher money. To solve this issue, the RBI has come up with something called as capital adequacy ratio. This is nothing new. It has been in existence for a long time now. Even the NHB had these the capital adequacy requirements. It basically says that in a loan that is given, some portion, I'll come to the definition of this sum, but some portion has to be contributed compulsorily by the equity shareholders. That is, for every loan that a bank or a housing finance company or NBFC gives, certain portion has to be carved out and kept. So even if the bank or the housing finance company has ample money, it can't give a loan until and unless it has satisfied the capital adequacy norms. Now, how do you calculate capital adequacy norms? Tier 1 capital plus Tier 2 capital divided by the risk-weighted assets. Basically, the concept which we just discussed is that the debt holders are taking a risk. Now, if you look at the asset side of the balance sheet now, all the assets may not be as risky. So, the money that the housing finance company is holding as cash, or which is held with the government in, say, RBI bonds or other government securities, there the risk is less compared to a loan which is given to outsiders. So, and even when we dissect the loan book also, each loan customer will carry a different risk. So, for example, you are giving a loan to a stockbroker versus you giving a loan to a person who's salaried. So, the person who's salaried will have a lower risk versus the person who's a stockbroker. I'm not making any judgments. I'm just saying that by and large, this is what it is. So, basis the business or basis the kind of employment you are into, there is a general risk perception. Okay, so you need not take any, there's no straitjacket definition that stockbroker is always risky. It may be the other way around also, but by and large, this is what it is. So, the RBI has given a list of risk weights, which is based on general perception and the experience that the RBI or NHB as the regulator of the finance sector has. They have said that certain assets are to be classified as zero risk, certain assets need to be classified as 100% risk, and other assets will fall somewhere in between. Now, when you say zero risk, that means some like assets like cash, balances with bank, government securities, etc., where the risk is zero, the 100% contribution can come through the debt holders also. Nothing may come from the equity shareholders because there is no risk of losing money. 100% of the contribution can come from the debt holders. Whereas in loans which are riskier, there has to be a certain portion which is coming through the equity shareholders also. Now, this is a mathematical formula where they have said that a weighted average of all the assets has to be considered when you are calculating the contribution that needs to come from the equity shareholders. Now, if you are working in a housing finance company, you would have seen that loans which are less than 30 lakhs are priced at a particular interest rate. Loans between 30 lakhs to 75 lakhs are priced a little higher, and those above 75 lakhs are priced a little more higher. You also have certain pricing which depends on the nature of employment. So, employed people pay a lower rate of interest versus those who are self-employed pay a little higher rate of return. This again, I'm making the statement which is general in nature. There may be products where the situation may be a little different. Why is this so? Because the RBI or NHB earlier said that loans which are less than 30 lakhs have a lower risk. Those which are between 30 lakhs to 75 lakhs have a higher risk, and those above 75 lakhs, there is a higher chance of losing money. which is obvious because if you're given a loan worth 20 lakhs and if there is a loss, then the loss may not have a major impact in the balance sheet or the finances of the company versus a loan of 1 crore going bad. A loan of 1 crore going bad typically means that 5 loans of 20 lakhs each have gone bad, if you look at it that way. Why is the pricing higher? The pricing is higher because the RBI or NHB wants a higher contribution to come from the equity shareholders. And because they want a higher contribution to come from the equity shareholders, the rate of interest has to be higher. Because as an equity shareholder, I will say that if I am contributing more, I want a higher share in the profit also. So you charge a higher rate of interest. That the capital adequacy ratio has to be maintained. Now this capital adequacy ratio, I'll reiterate, is nothing but the contribution that has to come from the owners to the risk weighted assets, which is tier 1 capital plus tier 2 capital divided by the risk weighted assets. Risk weighted assets is nothing but a weighted average of all the assets that are appearing in the balance sheet. The loan book has to be dissected according to the loans that are given. So there is a list which the RBI has given. Your loan book has to be broken up into those categories. You assign the risks, you assign the risk weights, and you arrive at a risk weighted asset figure, which is nothing but a weighted average. By March 2020, the NHB had said that housing finance companies need to move to 13% capital adequacy. This increases to 14% in March 2021 and 15% in March 2022. Right? Before this, it was less than 13%. So now, as we progress and as the sector becomes more and more riskier, the RBI or the regulator, the NHB, wants a higher proportion to be coming in from the equity shareholders and lesser to be coming in from the debt holders. Now, I've used the word equity shareholders basically to mean tier 1 capital. Of course, there are other calculations which also happen in tier 1 capital, which you can see on the screen. There is something called as tier 2 capital also. When I started this topic, I said that the outside liabilities are generally fixed in nature. And when I say fixed for the rate of interest and fixed for the tenure also. And equity shareholding is a permanent capital which is lying with the housing finance company or the bank, which has got no fixed rate of return. Over the years, we've come to instruments for borrowing which are hybrid in nature. So you have something called as a perpetual debt. You have something called as subordinated debt. We'll again not get into specifics of these instruments because they are a topic in themselves. So all these instruments are considered as tier 2 capital. Now there is again a restriction on tier 2 capital also. 10% has to be tier 1 capital and the balance can consist as tier 2 capital. The maximum tier 2 capital you can have is 100% of the tier 1 capital. So the other aspects which form a part of the prudential regulations is asset classification, provisioning and income classification. So what is asset classification? Asset classification is that all the assets which you have, basically your loan book, you have to classify them as standard or non-performing assets. That is performing assets or non-performing assets. Why is this required? Is that in a housing finance company or a bank or an NBFC, the raw material is money, the finished product is also money. And because they are dealing with money, they will need to disclose to the world at large what is it that they are actually doing with the money. So all the loans that have been given need to be classified as performing assets or non-performing assets. The definition of non-performing assets basically says that any loan where the interest or the principal has remained overdue for more than 90 days is to be taken as a non-performing asset. Non-performing asset does not mean that it's a write-off, does not mean that the bank or the HFC has lost the right to claim that money, but it is a classification and a higher provisioning needs to be carried. Whereas standard assets are those assets which are not overdue for more than 90 days. Now, once a loan has been classified as an NPA, you also need to further classify it. The reason is that something which has remained overdue for more than 91 days versus something which has remained overdue for 5 years, there is a difference. Something which has remained overdue for 5 years, more or less, that loan may not come back. Again, I'm not saying that it will not come back, but there is a higher chance that the loan may never come back to the company and it may go as a write-off. Versus something which has remained overdue for more than 90 days, say 91 days, there is a chance that the finance company can push the borrower and recover the money. So, an NPA is to be further classified as substandard, doubtful, and a loss asset. Now, what is a substandard asset? Substandard asset is an asset which has remained an NPA for less than 12 months. A doubtful asset is an asset which has remained substandard for less than 12 months. There is no definition of loss assets. There is no straitjacket definition of loss asset. Loss assets are basically those assets which the HFC or the auditor or the RBI during its inspection have come to a conclusion looking at various other factors that this loan is more or less written off and there are very minute chances of the money coming back. Also, cases where there is a fraud, where forged documents have been given or the property has been fraudulently sold off or there are other instances of fraud in the loan, those assets also need to be classified as a loss asset. There can be other instances also, like where there was a damage to the property and an insurance claim had been lodged, but for some reason the insurance claim has been rejected by the insurance company. There again, the chances of getting the money back is very less. You will be able to notice that a lesser provision is required for standard assets, and as we move in the bucketing for the NPAs, the provisioning is increasing. The other thing that has happened recently is that while this 90-day time frame has always been there for years now, the finance companies were declaring an NPA only when it remained overdue for 90 days. So it was only after 90 days of the debt remaining due did the world come to know that there is some problem with this loan. In order to ensure that there is more transparency and there are early signs of information to the shareholders and to the debt holders, there is a classification which the RBI has prescribed, which is stage 1, stage 2, stage 3, or SMA 0, SMA 1 and SMA 2. Basically, all those loans where there is a default need to be classified under these 3 buckets. So something which has remained overdue for less than 30 days, something which is overdue for 30 to 60 days, and 60 to 90 days. So the moment a loan is classified as SMA 0, the shareholders or the debt holders will get an idea beforehand that there is a small chance that this loan may go bad. It may so happen that there is a recovery which happens and the loan moves outside of this classification, but it gives an early warning sign. So that is why on any business channel, when you watch these results, they write a line saying that the asset quality has deteriorated or the asset quality for this particular bank or HFC has improved. What they mean is that when they start carrying a lower amount of provision, that means the perception or the risk perception has started going down and the asset quality overall has started to improve. The next part of the prudential regulations is income classification. Now, we've already spoken about the fact that the raw material and the finished product both are money, and that is why the income, which is again money, is emanating from money itself. So how do you account for the money is also very important. The RBI has given detailed directions on how the income has to be classified, how do you categorize income, and where do you book the income for different kinds of income. For example, when you are looking at income from dividend, it has to be booked when the right to receive has established. That is when the AGM has happened of the investee company and they have declared the dividend and the resolution has been passed. You have the right to receive the dividend, and it is only at this time can you go ahead and book the income, not otherwise. As far as NPAs are concerned, the income can be booked Only when the asset has been realized, not till then. So otherwise, for a performing asset, income has to be booked on an accrual basis. So every day the interest can accrue and every day the income can be booked. This continues only till the time an account goes as an NPA. Once the account is an NPA, all of this income needs to be reversed, and only when the loan has been realized can the income be booked, because it is already a non-performing loan, so it can't be set at par with the performing loans. Now I'll connect all of these things, the income recognition, the provisioning, NPA, performing assets, and the capital adequacy with the recent scams that have happened. Now whatever I'm going to talk about is based on facts which have been published by the media and the reports which have appeared in the media. You have seen that in the recent past, there have been public sector banks, especially after demonetization, a higher chunk of the money was received by the public sector banks when compared to the private sector banks. So there was ample liquidity which was available in the banking sector as a whole, and a major portion of this liquidity was with the public sector banks. However, you would have seen that there were various banks which were put by the RBI under prompt corrective action, PCA framework. PCA framework is when the RBI issues directives to a bank saying that there is something which is wrong, and if you continue with this practice, there is likelihood of more damage happening to the bank and the financial sector as a whole, so you please stop. They will issue directions as to what is it that the bank can continue to do and what is it that they can't continue to do. There were also banks which were banks like Lakshmi Vilas Bank or Yes Bank which were put under moratorium, and specific directions were given for each of these banks saying that there were certain kinds of loans that they could not give or certain deposits that they could not accept or redeem. We will not get into specifics of the directions given to each of these banks, but broadly these were the directions that were issued. Many public sector banks were a part of the PCA framework, prompt corrective action. Now one may ask that if the bank has a lot of money, why is it that they were not able to lend? Okay, this is a logical question, right? The bank needs money to lend, it already has the money, then why is the RBI saying don't lend? Or why are they not able to lend even for those PSU banks which were not in the PCA framework? The reason is very simple. The reason is that they were not able to meet their capital adequacy norms. Now what has capital adequacy got to do with liquid money? For those who are from the accounting background, we'll understand this better, but for those who are not from the accounting background, I'll take 2 minutes and explain. The balance sheet which we just said, as far as the equity shareholders funds is concerned, consists of the share capital which they have contributed plus the profit and loss, the profit which has accrued over the years. There is another statement called the profit and loss statement, which consists of the expenses on the left hand side and the incomes on the right hand side, and the balance of the income over the expenditure is called as profit. This profit we just spoke is attributable to the equity shareholders because they are the ones who've taken the risk, and this profit is arrived at after taking into consideration the interest that is payable to the outside debt holders. So now in the balance sheet, the profit will get added over there, right? So it will form a part of the equity shareholders funds, and because of that it will also form a part of the tier 1 capital, and it will have an impact on the capital adequacy, the formula which we just saw. Now what will happen is that suppose a loan goes bad, there is an NPA and the bank has said that, oh, there is a fraud and I have to write off this loan. How does a write-off work? Write-off will do nothing but hit the balance sheet. It will have to be accounted for as an expense on the profit and loss statement. The moment you account for it as an expense, that as in when your expenses increase, for whatever reason, your profit starts to come down. The moment your profit starts to come down, it automatically pulls down the owner's capital, the own funds, and because of that the tier 1 capital comes down, and it has an overall impact on the capital adequacy ratio. So the higher the bad loans, the higher the expense on the P&L, lower the profit, lower the tier 1 capital and lower is the capital adequacy. So while you may be sitting with all the cash, but if your loans which have been given in the past start to haunt you, you will face problems in capital adequacy. And because some of these banks were not able to maintain capital adequacy, they had to be told to stop lending and to maintain a status quo position and not to damage the balance sheet further. And after that, there are several other reasons also, but this was one of them, that after that, all these banks which were considered to be weak were then merged with the banks which were considered to be stronger. So you have to remember that whenever you look at results of any bank or any finance company, including an HFC, apart from the fact that the profit is important, what is also important is the NPA number and also the provisions. As the loan becomes more and more riskier, the provisions increase. So if you see the provisions which are increasing, assuming they are on account of higher risk, there is a risk of they turning into write-offs and eventually impacting the capital adequacy norms. Correct? So I hope I am clear on this and you understood what the prudential regulations mean. There is also one important part of the prudential regulations, which is concentration of credit. So when we talk about concentration of credit, the RBI or NHB has said that maximum of a certain percentage can be given to a single borrower and to a group of borrowers. When we say a group of borrowers, that means suppose we consider A Limited to be one company. You have a sister concern of A Limited which is B, another sister concern called C, and a subsidiary called D. So when it comes to lending to A Limited, the maximum that you can lend is 15% of the owned funds. Owned funds formula we saw in the previous slide and it is appearing right now also for your convenience. And A, B, C and D all put together cannot exceed 25% of the owned funds. So let us assume that your own funds is 100 rupees. The maximum that can be lent to each of these entities is 15 rupees and all of them put together cannot exceed 25 rupees. Right? Now there is also a possibility that you may not give loans but you make an investment into the company by way of holding shares. In that case also the same limits apply, 15 and 25%. And if you are looking at a situation which is hybrid in nature where you have a loan and an investment, both of them put together, these limits stand at 25% individually and 40% for the group. Now, why have they come up with concentration of credit norms? The reason for coming up with concentration of credit norms is that you don't put all your eggs into one basket. So that if that particular lender or that particular group goes down, it should have a contained impact on the finance company. Of course, it will have an impact. I'm not saying that it will not impact at all, but the impact will be contained to the fact that they have invested only 25%. Now, a living example of this is the PMC Bank. Again, whatever I'm going to talk now is based on media reports and whatever the media has reported. In PMC Bank, the loans were given to one particular institution or one particular group of companies, which was about 70% of their own funds. And there was an angle of fraud to it, which we will not get into right now. But almost 70% of their own funds was given to one particular group of borrowers. And because that particular group of borrowers went bad and they started to default, the bank as a whole had to suffer. Now, had they given only 15% or 25% to that group, the impact would have been much less than what we have right now. That is why concentration of credit norms are very important and these need to be followed. So the RBI and the NHB, when they come for inspection also of the books of housing finance companies or the banks, they ensure that these norms have been met. Another part of the concentration of credit norms also talks about the investment that the banks or the finance companies can make. So as far as housing finance companies are concerned, they need to have a board approved investment policy which will contain the kinds of investment that they can make, the sectors where they can invest, and the income accumulation for the investments. It also has a restriction on holding of land and building. So housing finance company, while it may be dealing with real estate day in and day out, the principal business is supposed to be giving loans for housing finance and not to hold housing for its own use. So as long as the HFC has invested in offices or space which is for its own use, there is no problem. But for those properties which are held merely as investments, there is a cap that the RBI has prescribed, which is 20%. And out of that, investment into land can be maximum 10%. So they can't be holding land beyond 10%, and the land and building both put together has to be 20% maximum. Now, apart from the investment in land and building, there is also a possibility that the finance company may want to temporarily park the funds into capital market. Capital market is equity shares, debentures, or other financial instruments. There also, considering the risk perception and the fact that the principal business of a HFC is supposed to be housing finance and not equity markets or capital markets, there is a cap on the amount that can be invested into these markets, which is 40%. So they can't go and exceed 40%, and the maximum 40% has to be invested into capital markets.